get started, good afternoon, good morning. We're all coast to coast here, so we're excited to have you here at our year-end planning for businesses and their owners webinar. Before we get started, I just wanted to help frame the bigger picture around the reasoning why we offer so much great content at Armanino and education and timely insights for free. We live in such a disruptive time in life and business, and disruption is happening all around us and at an expedited pace. It used to take hundreds of years, but now it happens so much quicker, and sometimes seeing large change within a decade. And you can see that on the slide here. The companies that are thriving right now are learning new ways of doing business. They are looking for new opportunities around their people strategy, operations, how to successfully navigate disruption and transform digitally. They are putting a central focus on clients instead of products or service, which completely is changing the landscape into a customer-centric view. We know organizations must keep up with the change. Today, we're going to be focused on empowering operations, which will help you stay informed and up to date in today's marketplace demands. Before we get started, I have a few tips on using our Zoom platform for today so you can engage with the presenters and have the best experience possible. You should follow the icons on your Zoom toolbar. You can ask a question or use the chat. We encourage you to ask questions throughout the presentation. We will address questions kind of through each section of our presentation today, so keep asking them. If you experience any audio issues, you can access your audio settings and test your audio when you are already in the meeting. Follow these instructions at the bottom left-hand corner of your Zoom meeting toolbar. You'll either find a headphone or a microphone logo to join, audio, or mute. Okay, requirements for CPE. Today's webinar does qualify for CPE credits. In order to qualify, you need to respond to all of our polling questions and stay on for the entire duration. If you have any technical difficulties, including the polling questions, please email elevate@armanino.llp with your name, date, and name of the webinar and the responses to your polling questions. I also wanted to mention an upcoming webinar we have from our private client advisors group. We're having a year-end planning webinar for high net worth individuals next week on December 8th. If y'all want to scan that QR code and get registered, we're excited to bring you a great panel of speakers. Today we'll be focusing on businesses, but next week we'll be focusing on individuals. So please register today. If you miss the QR code, you can always go to armaninollp.com and you can register there. Our learning objectives today are discovering year-end strategies for privately held businesses, which is why you're here. We're going to discuss state and local tax changes as well in year-end strategies for that as well. And we're going to evaluate the current M&A landscape, what's going on. And then also you'll see on our screen our basic CPE information. And so for today's presenters, I'm going to throw it to my team and let them introduce themselves.
Good morning. This is Tony Lamb, based out of San Ramon, California, here in the Bay Area. Look forward to having a great presentation here.
Hi, my name is Brandy Tillman. I'm a National Managing Director in state and local tax with a focus on income franchise as well as sales and use tax, and looking forward to being here today.
Hi, y'all. I'm Diane DeCesar. I'm a partner in the tax office in Philadelphia. I specialize in M&A planning for sellers to maximize their cash flow through tax planning and review of the financial terms of a deal.
Awesome. Great. Thanks, everyone. And let's go over quickly our agenda. Again, we're going to really cover those objectives, of course, but our agenda is going to be with Tony covering our year-end strategies and tactics. Brandy's going to be covering our SALT changes, and Diane is going to be covering our current M&A landscape. And then we'll also have questions at the end. But again, please ask your questions throughout. We would love to answer them. And first, we're going to start with a polling question. You should have it up on your screen. How do you feel prepared for year end? Okay, we have a lot of getting theirs. We have a lot of yeses, have some nos. Okay, you guys have a few more seconds. Okay, we're going to close the poll. And here's our results for today, just so everybody knows we have a pulse. A lot of people do feel prepared. A lot of people getting there, which is why you're here today, and some no's. And thank you for being here. We would love to help you and answer questions today, so please ask. Okay. With that, I'm going to turn it over to Tony.
Great. Based on the feedback, many of us are getting ready for year end and getting there, and that's understandable given the fact that we're in November. And so, as we talk through some of these planning ideas, key points here is basically we want to close out our November books timely, so we can project out 2022 income, and also in addition to that, forecast our income for next year in 2023. Currently, the tax rates are the same for 2022 and 2023, but then we still kind of want to look at where we are given the market and economy that we're in, what kind of issues and opportunities we have for the future in 2023, and so that we can look at different strategies for your business and how they apply to you. And so the first slide here is basically we want to compare the benefit of deferring and accelerate income for 2022. Some of the items we want to look at is whether we have any tax credits that are sitting in your tool shed, any passive losses, any credits such as research tax credits that some may be expiring, quite frankly. So you want to look at that. Any passive losses that are available, or maybe whether your level of activities for passive income, whether you have risen to a level that you're no longer passive, how does that come into play? So if some of you may recall the passive test, you need 500 hours or more. There's a couple of tests. You might be able to be going from passive to non-passive. So that might be important to you. So we want to look at where your income is for the year, and next year, maybe you have a loss this year and income next year. How does that work? Then there's the 3.8% net investment income tax on interest, dividends, and also passive income. So, for example, if you are under 250, you might be able to get out of the 3.8%. And also, if you are materially participating in your closely held business, you might be able to get out of the 3.8% net investment income tax on your flow-through income. So that would be a good discussion before year end, kind of like look at where you are in your activity, see whether you can group certain activities together to avoid the 3.8% net investment income tax. For some of you might be still looking at selling your closely held business by the end of the year, getting some offers out there. There might be ways to avoid that 3.8% tax as well through your flow-through income. And we kind of talked about also the loss carryovers and credits. Now, net operating losses are no longer allowed to be carried back. So you kind of want to look at, see whether you can use those losses this year or next year as well. Capital losses cannot be carried back. And then we'll talk about how we want to take advantage of that as well. All right, Katie, can we go to the next slide, please? We talked about a little bit of deferring income and accelerating expenses. One way to defer income is if you are selling, let's say, your stock or your majority of your business assets, and you're receiving cash plus note. And with the note payable to you, then you will not be receiving cash in this year. So there's an installment sale treatment that you may be able to elect in or elect out. By electing into the installment sale, then you're essentially going to be recognizing income and gain as cash is collected. So that is one opportunity for you in an installment sale. Now, one of the items that's not eligible for installment sale is inventory and depreciation recapture. Just bear in mind with that as you're going through. If you're selling assets, you kind of go through the different assets you're selling, goodwill, fixed assets, stock, etc. look at the opportunities for electing installments sales, see whether that is a good option for you. So talk with your tax advisor on that. Next slide, please, Katie.
Tony, we do have one question. Charlotte had a question that you said 250. Is that 250,000?
Yes, $250,000 at the individual level.
Okay, great.
All right. So one way to look at also to minimize your taxes for 2022 is to kind of get a good idea what your bonus plan will be for as you wrap up year end and closing out December books. These are three prongs. Together, they're known as the all events test for an accrual basis employer. This is where you have bonus liabilities owed to employees. Bear in mind that you would need to pay that by 2.5 months after year end for employees. For owners, you need to, basically pay it by end of the year. So the three tests are all events have occurred that establish the fact of the liabilities, and then the amounts has to be able to determine it with reasonable accuracy, and then there's the economic performance has to occur with respect to liabilities. The IRS does have a revenue ruling 2011-29, which covers, provides a little bit of illustration and color to the first test of the all events test. So can we go to the advance the next slide, Katie? Thank you. Within the rev ruling 2011-29, this is the fact pattern is basically there's a bonus payable to a group of employees. The employer does not know the identity of each recipient, and the amount of the recipient payable to the recipient is not determined until after the year end. So in this case, the IRS said, okay, you're eligible for the bonus if the employee had performed the services and be employed on the date of the bonus is paid out. Now, if the employee leaves, then that certain percentage or portion of that bonus is then reallocated to the pool, and that is actually okay. So the IRS determined that the all events test has been met, and that you may deduct that accrual liabilities in 2022. So this is something that you want to kind of have a, put that together, kind of figure out what you want for cash flow purposes and also for deduction purposes, and talk with your tax advisor on this as well. So a lot of times, depending on the business you have, given where we are with inflation, et cetera, in order to, compensate and reward your employees, this is something to take a look at. Next slide, please. Fixed assets. So this is something to look at, at the end of the year. Are there any certain fixed assets we want to acquire this year instead of January? So be able to front load that depreciation in 2022. One of the incentives to place that asset in service is that the bonus depreciation is currently 100% for 2022. It drops off to 80% in 2023. Now, the requirement for eligible to take bonus depreciation, or just depreciation in general, is that the asset has to be placed in service by 12/31/2022. Now, that means that the asset has to be at your premise and has to be installed and available for business use. And we've known a lot, given the market we're in with supply chain delays, installation time delays. We want to at least think about it. And if you need a certain equipment, furniture, fixtures for your business, let's look at that. Let's place the order in. Let's see if we can get that installed by end of the year and up and running, so that you can take advantage of these favorable bonus depreciation rules. The bonus depreciation rules apply to personal property such as computers, equipment, heavy equipment, land improvements, which are normally 15 years and under, so like fences, parking lots, things like that. And also, there's this interior non-structural non-structural parts of the building, which are known as Qualified Improvement Property, QIP for short, that came about with the 2017 Tax Reform Act. So definitely, talk to any of us or your tax advisor about what you can do to accelerate depreciation for federal. Many of the states do not conform, such as California. California does not conform to these favorable rules, but certain states do. So that's something to look at if you're operating in different states. Next slide, please. Thank you. Now then, in addition to fixed assets, then one of the big ticket item is the retirement plan. In the past, companies would rush by 12/31, in addition to closing the books, to kind of get a plan in place, because you had to have a plan in place for your retirement plan if you want to make changes or enhance it. Now you have time to look at it, review it, and actually adopt it. And you have until the extended due date of your tax returns next year to adopt a plan and make it retroactive, effective 12/31/2022. So for example, let's say you have a you have a 401k plan. Maybe you want to enhance that with a profit sharing component, or maybe enhance that with a defined benefit plan. So these are items that you want to talk with your tax advisor and your pension consultant to see whether there are ways that we can enhance the plan for your employees and the owners and take advantage of the deduction. This is definitely a big ticket item that we work closely with our clients on. Katie, can you advance the next slide? Qualified business income deduction, which is Section 199A for short, came about with the 2017 Tax Reforms Act, which if you qualify, it lowers the individual tax rates from 37% to about 30%. And this is a deduction you do not need to pay for. You just need to look at whether you're qualified business. Qualified businesses is pretty much everything except a laundry list of items of businesses that do not qualify. So accountants, attorneys, financial services, healthcare providers do not qualify. Consultants is a great area. So let's say you're consulting for a real estate company and you're doing real estate supervision of a project, that will be qualified, but you're just consulting a company to how to be more efficient, but you're not really part of management, then that you will not qualify. So consulting is a great area. So that's something that you need to look at with your tax advisor. And you want to look at it also activity by activity for your business. So you might have one activity for the business that does not qualify, such as consulting, but you're doing IT implementation, then that is qualified. So that section of your business, it does qualify for QBI deduction. And as you close out the year, you want to look at, are there certain hurdles that you need to meet in order to maximize the deductions? So these include wages. So wages, basically you need, you take wages times 50%. That is the base that's allowed for your QBI deduction. So you want to look at, in light with the bonus plan we talked about, wage for the rank and file and the owners, or the wages that we need to look at to maximize your QBI deductions. For real estate companies that don't have wages, so you want to look at your fixed assets. So you take your fixed assets, excluding land, and multiply that 2.5% for your QBI hurdle deductions hurdle. So a lot to look at. Is something that's definitely worthwhile. And again, you do not need to pay for this. You just need to see whether you're eligible and make sure you claim it. Next slide, please. Charitable contributions. So as we wrap up year end, it's a good season to be giving. So let's look at charitable contributions for the business as well as for individuals. One good tool is to look at is donor advised fund. So it's basically you can set it up with Schwab or Fidelity, and you basically, let's say you put 100 grand into the advised fund, then you can then let it grow and you get to manage the advised fund, donor advised fund. You can take deduction in 2022, and then down the road in 2023, as charities come to you asking for charitable contributions, then you just take proceeds from the fund and then make the charitable contributions that way in 2023. But then in 2022, you lock in the $100,000 of contributions deduction for 2022. So that is a nice way, easy way to make a charitable contributions. Next slide, please, Katie. R&D credits. Okay, R&D credits. So many of our clients on the call here are familiar with R&D. You are looking at technology, you're trying to eliminate risks, you're trying to improve, put together R&D process and for your business, right? You're looking at beta test number 2. The credit in the past is, you can still the case, you can offset income tax dollar for dollar. A lot of our startup companies, well, they are not in a taxable income situation. They're still able to take advantage of this by making an election to offset federal payroll taxes. In the past, it was $250,000 that can offset against Social Security tax, FICA for short. With the Inflation Reduction Act that came out earlier this year, they enhanced the R&D credit. Now you can layer on additional $250,000 of credit for payroll taxes that can offset Medicare. So the way it works is the first $250K go against FICA, the next $250K can go offset Medicare tax. So it's an aggregate $500,000 for our small businesses or startup companies who are experiencing losses. One rule to keep in mind is, how do you qualify as a small business? And here you can see the slide that an eligible entity must have less than $5 million gross receipts over a 5-year period, including 2022. So you go back 4 years from 2022, and no gross receipts before the 5-year period. Now, this is a little trap for the here in this case. So no gross receipts. So like, let's say you're a startup company, and in the first couple of years, you just have cash sitting in your checking account, and you might have incurred and accrued and earned a nominal amount of interest income for your checking account. Well, the clock already started at that point because you earned even $1 of interest income, no matter how nominal it was. So that you have to watch out for that no gross receipts rule before that 5-year period. So something to keep in mind, but it's definitely good to evaluate whether the R&D credit is beneficial for you for income tax versus payroll tax. All right, next slide, please. All right, solar tax credit. So this, in addition to the R&D credit that we just went through, that the enhancement to that, there's also a solar tax credit that was also enhanced. They brought it back to 30% for the credit benefits. So the installation can happen between 2022 to 2032. So you have a nice 10-year window to take advantage of this 30% credit. Previously, they were going to lower to like 26%, 22%. Now we're back to 30% on the credits. Then after you take the credit, what happens is then let's say your credit is $1,000. Then you're supposed to reduce your depreciable tax basis of the asset by half the credit. Then the remaining tax depreciation basis then is allowed to take bonus depreciation. And we had covered 100% bonus depreciation for 2022 and 80% for 2023. So you get nice acceleration depreciation on the solar tax, on the solar panels, as well as the nice credit you get for those tax credits. So definitely something worth looking at. All right, next slide, please.
All right, so we have a few questions. We actually have a lot of questions. So we're gonna cover a few right now, and then we'll save some for the end, okay? So Tony, is the Section 179 deduction still available?
Yes, that is still available. That is still true. So you can look at the comparative benefits of bonus as well as 179. What is interesting is that bonus depreciation can drive you into a loss situation, whereas 179 is limited based on business income. So you want to look at which is more beneficial for you in this case. In 179, there's also a cap. You know, the max, there's a cap on based on that phases out. So you want to look at the phase out as well as part of the equation. So definitely something to look at, bonus and 179, see what makes the most sense for you.
Awesome. And then Mike has a question. How long do you have to make the contributions from the donor advised fund?
It depends on your, I would imagine that you get to deduct it in the year that you make it. So that's a charitable contribution. So because that is the year that you will get your receipt for confirmation of the funding of the donor advised fund. So yes, I would say you make it by end of the year.
Okay, great. Awesome. So everyone that did ask a question, don't worry, we'll get to them at the end. We just want to make sure we get to our other two presenters. Thank you, Tony. And we're going to go into another polling question. 1 second. Awesome. Okay, here we go. What was your favorite part about Thanksgiving? Not a typical tax type of question. But we all just had a lovely holiday, hopefully. And I did have a number of questions about, will we be emailing the presentation? We absolutely will be. So you guys will get a recording and the slides afterwards. Okay, just a few more people. Are you deciding between family and football? Maybe. Few more seconds. Okay, we're gonna wrap it up, and of course it's family. Although some people chose food and football over family. That's your holiday. Okay, I want to know what the other ones are, but we'll have to save that for another time. We're gonna head over to Brandy and talk about state and local tax planning.
Perfect. Thank you, Katie. So state and local tax over the past several years has become more and more important, after the passage of the TCJA with the federal rate going down, and it made the state tax rate much more relevant to companies. In addition to that, probably one of the most seminal decisions in the last, 30 years, Wayfair came out in 2018. And this is a very common issue for companies to have. And it deals really with what the appropriate nexus standard is to apply. Wayfair was a sales and use tax case that basically overruled Quill and National Bella Hess, which were two sales and use tax cases that essentially held that physical presence was required in order to make a company collect and remit sales tax. However, Wayfair also has application to, next slide, please. However, Wayfair also has application to income tax. What we've found is that a lot of companies, even though Wayfair has been around for some time, are still not fully compliant with the requirements. Now there's essentially every state that has a sales tax has a Wayfair economic nexus provision, if you will. They do vary by state, but most are around $100,000 or 200 separate transactions, which is pretty easy for most companies to hit. And in the event a company, for example, is not collecting sales and use tax as they should be, the company, rather than passing this cost on to the consumer, will bear the burden of having to pay this should the state subject the company to audit. On the income tax side, the Wayfair decision also essentially overruled the physical presence standard and adopted economic nexus. Now, several states had actually adopted economic nexus provisions, primarily bright line factor presence standards that essentially look at property, payroll, or sales and whether a company meets a certain threshold in order to create nexus and hence a filing obligation in the state. Although these states had enacted these, for some time, now that Wayfair came along, the states are feeling more confident in enforcing them, which they have been, as well as we're finding new states that are also adopting economic nexus provisions. In addition, one thing I think a lot of people tend to overlook is even if the state does not have a factor presence nexus threshold, most states do have a very broad doing business standard, and the doing business standard is generally broad enough to encompass activity where you're deriving revenue from the state, exploiting the state's marketplace. So it's important not to focus only on the roughly 12 states that have the factor presence provisions, but also to look at your state tax profile holistically. Next slide, please, Katie. The other item that has become more and more prevalent, obviously, with the advent of COVID is employees working remotely. And what we found is, now that employees are very comfortable working remotely, a lot of employees are continuing to stay working out of their home. And oftentimes they even work out of different locations, whether that's vacation homes, family, and whatnot. And one thing that we found is that businesses are having a challenging time tracking where employees are performing their work activities. Now, this would affect not only a company having sales and use tax nexus, income tax nexus, but also payroll withholding requirements. So it is very important for companies to try to find some reasonable methodology of monitoring, the location of its remote workers, so that it's not, so that the company is not surprised once you register for payroll tax that in a year or two, the state tax authorities for sales and use tax or income tax come knocking at your door. This can be a real exposure area for companies, and based on Wayfair as well as the remote working environment, one of the things that we recommend that companies look at year end is their state tax nexus profile. It's always a good time to get an understanding of where the company is at, any gaps they may have, so that you can start the next year off knowing where your risk areas are, determining where you want to file prospectively, and determining if you want to take any risk mitigation measures. Next slide, please, Katie. State tax sourcing. So states over, the last decade have been migrating to single sales factor rather than incorporating, property and payroll in their in their income tax apportionment formulas. This has been fairly common as states look to shift the burden of tax liability to out-of-state taxpayers. But with the migration to single sales factor sourcing, we've also seen a similar migration to market-based sourcing. This started out probably back about a decade ago, and more states have started to adopt various market-based sourcing methodologies. And it's interesting to see, because usually when people think of market-based sourcing, we find that a lot of companies tend to think of billing address. And generally that's because that's one of the pieces of information that most companies have readily available. They have their billing address for their customers. However, you'll find that each of the states define market-based sourcing slightly differently. Some look at where the service is delivered, others where the benefits received, and various other components. And each state offers different definitions in terms of how to apply market-based sourcing. For example, California has cascading rules that requires you to look to each tier in order and to only move on to the next tier if the company is unable to provide the information for the higher tier. Interestingly, in California, billing address is at the third tier, yet we find a lot of companies are sourcing their sales based on billing address. And with a lot of large companies, the Facebooks, the Googles located in California, we found that there is a lot of opportunity for tax savings where companies do a sales factor sourcing analysis to see how to minimize their state apportionment formula, not only prospectively, but also going back to file refund claims. Next slide, please. Public Law 86272. So this is a federal law that was passed in 1959. Essentially what it does is it protects certain companies that have limited activities in the state from the state imposing a net income tax. It only applies to sales of tangible personal property. And generally, there's been published by the Multi-State Tax Commission a model rule that lists out protected and unprotected activities that a business can conduct in order to claim or break public law protection. And most recently, the MTC did a fourth revision. And in this particular revision, the interpretation was significantly narrowed, such that I would say almost every company that has an internet website will likely violate Public Law 86272 protection under this model rule, because essentially what it looks at is interactive website functions. So for example, electronic chat, the ability to click on icons to email the company directly. Can you switch to the next slide, please, Katie? Sorry. Going over the unprotected ones because they're a little more important. Offering extended warranties, putting cookies on people's computers other than for the purpose of other than for the purpose of solicitation of sales. And some of the states have started to adopt or consider adopting these provisions, California being the first one to do so. New York is currently looking at draft regulations. However, since this is a very significant, this will create a very significant tax burden for many of the retailers there in California. The ACMA has brought a suit against the Franchise Tax Board for basically contesting their ability to add those items as unprotected activities based on, that interpretation, the MTC's interpretation of the law, even though the federal statute obviously hasn't changed, nor have there been, very recent case law at the federal level on 86-272. Next slide. Let's go ahead and skip this one. These are just questions people can ask. I want to make sure. And then very quickly, with the advent of the $10,000 state and local tax deduction for federal tax purposes on individuals that was passed in 2017, many states have begun enacting these new pass-through entity tax regimes, which essentially allow a pass-through entity meeting certain ownership qualifications to make an election to pay state tax at the partnership level or pass-through entity level, which allows the partnership to then deduct that state and local tax liability and pass on a distributive share to the partners that is net of that deduction. Now, this essentially provides roughly a 35% benefit to individual taxpayers, and that would be 35% of whatever the state tax deduction would be, or the California PTET, the state PTET that has been paid. And we found that a lot of companies are taking advantage of this and saving substantial amounts of money making this election. We now have 29 states, as well as New York City, that have enacted pass-through entity tax regimes. And it's definitely something that companies that operate in a pass-through entity basis should definitely look at as a tax saving opportunity. And with that, let me turn it over to Diane.
Thanks so much, Brandy.
We're going to have one polling question super fast. Everyone get your mouses ready. Well, maybe, yes. Yep, here we go. What part of year-end planning are you most anxious about? Awesome, we're almost there. Pretty even split. Okay, I have about 20 of y'all. Okay, 5 seconds. We got to get Diane in. She's got great information we want to share. Okay, so we're going to close the poll right now. And there's our results. Pretty even across the board, except M&A. That's okay. Awesome. Okay, so we're going to go over to Diane.
Thanks, Edie. So we're just going to go over some conversation about the M&A landscape, as well as give you some ideas about the exit process and things for you to consider. So next slide. This first graph is just showing what the global M&A activity has been. You'll note that 2022 is only for half a year, but is on pace to exceed the biggest year, which was 2021. The reason for such a large increase in 2021 was some delays of deals from 2020 because of COVID, and also just lots of cash available for sales. So there's abundant capital in the market. Next screen. This just shows a couple charts about the M&A activity. The first one is the type of payment, whether cash is received, stock, or some combination thereof. You'll see that the percentage that has stock and cash has increased over the 11 years in this study. The second chart is to show you the sectors, and you'll see wide-ranging, not much changes except in the IT has had an increase from 2011. And the last one is the size of the deals. And you'll see that the top yellow, which is deals that are 5 billion or above, have increased over time. So the next slide shows a poll that was made by the Exit Planning Institute on what an owner describes as their plan for transition. So the internal slide is about 36%, and that's generational transfers, family transfers, management buyouts, partner buyouts, and ESOPs. About 31% expect it to do it externally with outside interests buying into the company. And then the rest were pretty unsure, also close to a 30%. Next slide. So it's interesting that people have on the prior slide have noted that they know where 60-something% know what they're going to do, sell internally, externally. But this last stat of 56% of owners don't have family alignment doesn't really work well with that other stat, which means that it's not an easy process. It's hard for the family, if the family business, to decide. And it's really an area where you'll see on our next few slides, what is the process, and getting advisors in early can really help you set yourself up for proper planning. And it's not only for purposes of an outside sale. If you're internally and doing succession planning, just as important to have these facts, in place. You see the other two factors are 20 to 30% of business go to market, don't end up selling, or only 20 to 30% of the businesses that go to market end up selling. And this middle fact of only 19% of family-owned businesses survive into the second generation has seen a sharp decrease. That number used to be about 33%. And a lot of people think that that's that millennials don't really want to continue with the family business. The next slide, Katie, it shows if owners believe having a transition strategy is important, and 99% agree, but only 66% of owners actually have a documented plan. So not only should we have a plan for the planned sale, but there should also be in place if there's ever a sudden succession planning. If the current person who runs the business should be unavailable suddenly, it's another part to the planning. So next slide just really is showing that exit planning is really a business strategy. It's something that your business should decide about the human impact, the structural impact, your customers, what's happening in the society, and plan for you and your family. So the next few slides, we're going to really go through what is the exit planning process. And what you're going to find is, unfortunately, it's not a simple process. And there's a lot of decisions to make and a lot of steps where you can work with your advisors to come to a good answer for you and your family. The first phase is discovering. We'll talk a little bit about business values. How does that relate with your own personal financial situation to actually prioritize a plan? And then it's the preparation phase in getting those values, looking at your business financials, seeing where there is risk, and making that master plan, which will allow you to decide, am I going to grow? Do I need to do more internally, create value before I decide to sell? Or are we ready to actually initiate the exit plan, which we'll also discuss. Preparing for this plan also helps not derailing the process so that you won't be part of that stat of only 20 to 30% selling, have a larger chance to have your business sold. So the next slides are going to talk about what's your business worth versus how much will someone pay for your business. So the first area and process that we could do, next slide, is getting a valuation. What is the purpose of the valuation? It's to say, is my business saleable? What should it sell for? Determining a starting point for negotiation. So before you're out there having buyers, having some due diligence yourself on what your business is worth. And then it'll also help determine if there's things that could add to value or detract from value. So the next slide says, what is the process of estimating and what will you have to go through and provide to allow us to help you estimate that value? So usually there's a review of 3 years of monthly financials. And you'll ask why monthly financials? It's because it helps to analyze the company's operations, the trends, to see where there's changes that might be extraordinary, that won't be considered by a buyer, right? We look at cash flow for not only for you, for the industry stats, and then look at those value drivers where we saw growth or learn from you about your growth. And at the same time, also see where there might have been any downturns, what detracted from value. So it'll be a deep dive, but will help you to, understand your business. Then the next slide are items that we'll review with you to understand if they are value drivers. Clearly, your management team, how good are they? How do they add to the value to a potential buyer? Your contracts with your customers and your suppliers are always really important, as are the non-competes with employees. The most important thing that a buyer is going to look at, though, is probably a proven track record of revenue and growth. So having those clean books and records is really important, and going through these process will really help us in that area. We can go to the next slide. But the most important area of all is preparing for a sale is to get your financials in order. So that's a really important reason why to prepare a financial statement for a sale. A specific sale financial statement is often called a quality of earnings report. And what does it do, and what does the process do if you hire someone to help you in that, is really make sure that your financial statements are clean, that the quality is increased so that your value isn't lowered by that, and allows you to understand your business before you go into an exit process where a buyer is going to be asking you lots of questions. So if we go on to the next slide, who needs to prepare this? So, in our point of view, everybody should prepare it. This quality of earnings report will help identify key issues, quantify risks, and just really help you identify items that will drive up value. One item to note is, we think it's important to do this to get what the maximum value of your company is before you hit a letter of intent stage, because whatever value a buyer puts on a letter of intent, that's probably the maximum value that you're going to get. They might try to work and find areas where your business is worth less. But if we go through and with you look at your earnings and your quality, we can try to start at the maximum value of your business and help, increase the cash flow for you. The next slide just says, what are the process and steps? And again, it's getting your accounting in shape, making sure we look at performance, look at a multi-year back and forward, so that we can help the buyer see what the benefits of what you set in place will be to them in the future, and can help you to communicate your company's value, which is really, really important. So the next slide just shows a glimpse of what a quality of earnings report looks like. It reports current year as well as prior year, both revenue, and then the big item is EBITDA, which is earnings before interest, taxes, depreciation, and amortization. It's not GAAP earnings. It's the statistics which a lot of multiples on sale is used, but it's not just your EBITDA that we look at. We actually try to normalize that, which means what would anybody running your company be able to create in an earnings tool? And that's what the buyer is going to use. So when you get these slides, you'll see a bunch of different items that can be adjusted out. Some of those items are extraordinary items. Almost always it's owner's comp. And if there's any personal expenses that your company's paying for. And, in this process, it also helps to identify, are there assets that aren't sell, that you don't want to sell? Are there expenses related to those assets that should actually come through? So again, identifying value drivers and any issues that a buyer can find before they find it. So the last section, we're going to talk about tax implications, but first we're going to have a poll.
Cool. This is our last one. So everybody look alive. Would you like to connect with someone from Armanino regarding year-end planning? That can be this year or next year. All right, about 30 of y'all left. This is our last poll. Okay, we're going to end the poll. And I'll share the results just so y'all have transparency. Okay, and we're going to go back to Diane.
Thanks, Randy. So these are items that to consider in a deal structure that can impact your tax and your cash flow. Tax is probably one of the largest costs you pay throughout your life in your financial circumstances, and clearly is a huge cost if you're going into a transaction. So the first green slides are what type of sale are you going to have? And that really impacts a seller's tax, whether it's a sale of equity, the interest, your shares, or whether a sale of assets. Sale of assets typically results in a higher tax for the sellers of a business. And hopefully with the help of a professional, there'll be plans to try to have the buyer take on some of that liability if possible. The next level, the oranges, is what entity structure do you have? Or should we consider if you're considering a sale? Are there changes that are maybe driven by the buyer or that we should drive prior to engaging a buyer? The darker blue is the type of consideration. We mentioned that already. Cash, it's the seller financing. Earnouts are sometimes when the buyer isn't so sure about your projections for growth. They'll require you to hit those and give you the sales price in the future. And in a lot of deals we're seeing, especially those in private equity, you might be requested to roll over equity, meaning keeping some of your foot in the new deal with the new buyers, being partners with them in the future of the company. The last lighter blue items are actually deal terms. We'll talk a little bit more about net working capital, but purchase price allocation is a really important thing that we spend a lot of time on to try to minimize the tax consequences to a seller and actually maximize your cash flow. And the gross up is something that we often request from a buyer to help make you whole if you're asked to sell assets instead of selling stock. And there's not only consequences in the character of the tax, meaning ordinary instead of capital gain, which is more beneficial, but there's also state tax consequences. Brandy mentioned pass-through entity tax. Really important to think about pass-through entity tax before a sale and hope that we're qualified if it is an asset sale so that you can get a deduction for those large state taxes that you might be paying in a sale. The next slide is other considerations. And luckily, Tony already talked about installment sales, which is a way to defer some of the gain to the future. Some other planning could be done pre-sale in order to maximize the benefit for the family in the future. We do gifting and transfer some interest before the sale, which really is important if there could possibly be a sale of C stock and QSBS, which is qualified small business stock, all for another day. Post-sale ideas and issues are opportunity zone, protecting your proceeds, and talking to your financial advisors to make sure now that you have assets outside of a business that you're diversifying your holdings. The next slide is working capital, and there could be a whole seminar just on working capital. But working capital is your current assets, just your current liabilities, and it's really where professionals can help you in understanding what the buyer's going to ask, help you set the target set at what kind of net working capital is needed to run your business. And then that's something that's trued up, meaning after 60 days, the buyer will do a computation of seeing what the actual working capital is. And the difference is actually either a cost to the seller or more cash to the seller. So this is an area where it's really technical. You need to understand the terms written in the agreement, and put our best foot forward. So having you understand your working capital needs and putting them in the best light to a buyer is really someplace where, professionals can help you now, get you more later. So the last slide is just an overall summary of a graphic that we do to help you understand what net cash you will leave with if you decide to sell your business. Doing this early is really important because it can help you decide, is that what I thought I'd get? Do I need to get more? Do we need to grow the business? What we do is a waterfall to estimate not only your proceeds, but the use of those proceeds to possibly pay off debt, transaction cost, as well as then what are the tax consequences from this transaction. So what cash will each seller walk away with? It's a proprietary and unique computation for every buyer, for every potential buy, for every deal. If you do it at the letter of intent stage, you can then easily compare different proposals as well as then use it for any agreement changes. And we will end it there.
Beautiful. Okay, so we have time for maybe one or two questions for Diane. So Carolyn has a question. If such a low percentage of family businesses sell, what happens? Do they not sell? Do they just shut their doors?
No, a lot of businesses don't sell because of questions that are asked, because financials weren't in great shape, because we didn't have answers that made a buyer happy for the sale. So unfortunately, it's a hard way to have a learning process to actually put in place plans that will make you have a successful sale. So no, it doesn't typically just close the doors.
Awesome. And then we have one more question. We have 2 minutes. How do you account for the impact of the pandemic on the 3-year look back?
Yeah, a lot of buyers look at that differently. Clearly, any companies that came out of the pandemic strong are in a better situation. But we've had buyers consider that, and sometimes looking back even longer to show a growth history before and after the pandemic that helps show where we really are in the world.
Great, thank you. Okay, and so if we didn't answer your question today, we will follow up. And I know there was a ton that we didn't have time for today, unfortunately, but we will follow up. Thank you everyone for attending. Please remember to complete the survey as you close out of the webinar. And we hope to see you soon. Thank you all. Goodbye.